My name is Seewing Yee, and my special guest once again is Mr. Richard Advani, who is a top-notch real estate investment loan agent who does loans for investors in all 50 states. Richard Advani, thank you so much for your time. Today's module, we can talk about for real estate investors, potentially should you tap into your home equity of your primary home or home equity from your investment property to continue to buy rental properties in this challenging market. I'm going to run this scenario with Richard Advani because you are an investment loan agent with guaranteed rate mortgage. You do this kind of scenarios with investors all day long, every single day. So you run this kind of analysis for your investors who we came to the right person to address this type of things. Before let me finish this quick rundown of what's going on right now. Most people who have mortgages, they have amazing historical low rate. They have a lock-in effect. 65% of the homeowners have mortgage rate of 4% or below. 25% of the mortgage holders right now have an interest rate of 3% and below. And 40% of the homeowners in the country have no mortgages whatsoever. So we are experiencing a historical U.S. home equity surge of over $27 trillion with a T, $27 trillion of home equity. This is absolutely mind-boggling. Homeowners are just making a killing in this housing market, especially in the last couple of years ago when they bought in 2021, and they reaped the benefit, and everyone else, they regret it, and they missed the boat, if you will. So giving this home equity and based on the massive amount of equities that Americans are sitting on, as you can see the breakdown, I'm not going to go over the breakdown, but suffice to say, so the question you have, again, Richard, I'm going to ask you some, if an investor if they've done the proper research in many markets and they feel comfortable, they have a team, they have a network of team to help them buy properties long distance, out of state, turnkey, whatever the case may be. They can pick a Midwest market, very high cash flow, relatively speaking. So you look at with somebody with a cash out refinance their principal home or get a line of credit from the principal home. That way you can preserve the low interest rate, but to take out a line of credit for 100 grand, 150,000, even at 8% rate on the HELOC is quite high. But you look at the amount of money you can cash out based on, then you buy different kind of properties in different markets. But the down payment on this low price property in the Midwest is only 20 grand to get you the nice cash flow. This property in Midwest and in Alabama, for example, 190K, only like $50,000 down payment, whatever, and still cash flow. And if you want to buy in a fast growth cash flow and appreciation market, new construction in the South and Southeast, you look at the down payment you have to put up with, in this case, 84 grand, but look at the return, not just the first year projection cash flow, but over time when your investment property grow in value in many different ways. So the question, and then, so all these scenarios, again, most primary homeowners who have no interest in buying rental properties, they can stick on their historically low mortgage for the rest of their lives. That's fine. Eventually, they can have a free and clear property. But for investors who are very motivated, who have those kind of low rate mortgages, have tons of equity from the primary home and investment properties as well. So, Richard, you work with buyers, investors every single second, every day. So I know every investors are very different. Their goals and objectives are very different. Their risk tolerance is very different. And the timeline of their goals are very different. But having said that, just share with me what are the risks involved. Should the investor cash out refinance their rental property if they could? Or I understand investors, they want to preserve the low mortgage rate on their primary home. But what's wrong with getting a line of credit for 100 grand, 200 grand, if they can qualify, even at a HELOC rate of 8%, giving the numbers are already crunched on the pro forma with the various markets, right? The various properties and the returns, not just short term, but long term, 5 to 10 years projected return of investment property. You could make the argument that the long term return of an investment property can justify taking a somewhat of a risk to tap into someone's equity to increase generational wealth for investors. I know that's a very long-winded presentation by myself, but so with that in mind, go ahead and share your thoughts, given scenarios. Go ahead.
Yeah, absolutely. I mean, that's like you said, it's a tough scenario because the numbers obviously need to make sense. And if it allows you obviously to diversify the equity you have already in a primary home or rental, then it could make sense, right? The thing that gets increasingly difficult in this market, though, is with where the rates are on these equity lines and second mortgage products, pushing north of 10%. It's obviously almost impossible to purchase a property with just 25% down and have that cash flow completely cover your equity payment. It is possible, though. Finding the right deal, getting with Seewing to find a property that generates enough cash flow to where it can cover the mortgage payment of itself, as well as potentially the equity line payment that was taken out for the down payment. It could make a lot of sense, especially because even if you're taking your equity from a break-even situation, or sorry, even if pulling equity, let's say, out of your primary home to purchase this rental, even if you're in a break-even situation, you're essentially diversifying your equity that you had in that primary home. Now, I personally am a proponent of leveraging responsibly and not over leveraging. That way you're strong in positions when there is economic turmoil. However, it's about finding that balancing act. I would say, frankly, more often than not, the numbers do not make sense on these. It is very difficult to find, once again, properties that will generate enough to cover that high rate equity line. But it does happen, and it is possible. I think there's been at least one client of Seewing's where he was able to locate a very high cash flow property, and pulling out the equity line, even with the higher rates, still actually penciled out and still made sense for that customer. And then keep in mind also that same logic and rationale, these equity lines are going to be able to refinance in the future as well. Yeah, it's definitely a great option. Not as good as it's been historically, just with where rates are, but it still takes us back to, you can wait until everyone else is trying to go out and buy properties, or you can get ahead of the curve now, acquire your properties, and then as we move into next year, refinance them to increase cash flow and drop the interest rates, of course.
Okay, Richard, if I understand you correctly, correct me if I'm wrong. My takeaway from your comments, again, yeah, that's right. One of my investors are doing the very same thing. And he has, Joe, his name, he had ran the numbers with me and with you as well. So three of us working hand in hand. And he felt that the cash refinance from his rental property and potentially doing a HELOC, it makes sense to him because the research he has done is that he has found a great cash flow properties in a good area, and that cash flow was able to pay off his monthly line of credit debt, his monthly refinance debt on that subject property that the money is coming out of. So I mean, not everybody willing to do that, I understand, but again, you and I, Richard, have worked with investors from all walks of life. Some are very committed. They are very courageous. They are very ambitious. They understand the long-term benefit of buying a property with the equity building over time. So they are willing to accept the risk. But some people, especially newbies, they have a lower risk tolerance. They may not be willing to tap into their home equity. So at the end of the day, if you can make one additional argument that people sitting on an equity over time, they're sitting on equity that is debt equity, right? They not, it's fine. Some people feel comfortable having a free and clear mortgage. There's nothing wrong with that. Don't get me wrong, but not able to tap into your equity to leverage into more wealth, understands risk involved in long term. There's nothing wrong to do that for some savvy, sophisticated investors who have done research and due diligence, who tap into the resources they have available, the resources that I have within my network, in my knowledge and experience. And of course, you as a loan agent, Richard, you have done this kind of scenarios. You help investors to punch the number to determine whether the risk versus reward is beneficial. So at the end of the day, it's each investor situation, what makes them feel comfortable. So it's not a right or wrong answer, but that's pretty much what we have for this module. Thank you so much, Richard, for your great analysis, real-time practical solutions for investors out there.